Imagine I handed you a punch card. Just one. And on it, only 20 slots. Every investment you make for the rest of your life punches a hole. 20 holes, then you're done. Forever. Sounds like a punishment, right? Warren Buffett thinks it would make you rich. I've watched investors for 50 years now. And the ones who blew themselves up? They almost never did it by being lazy. They did it by being busy. Trading, tweaking, chasing the next hot thing. Buffett's 20-slot idea flips everything you've been told. Because the secret to better returns isn't doing more. It's being forced to do less. And there's hard data, real numbers from 66,000 households, that proves it. Here's how Buffett actually framed it. He said he could improve your financial life by giving you a card with only 20 slots representing every investment you'd get to make in a lifetime. Once you punched all 20, that's it. No more. Now think about what that does to you. Suddenly, every decision matters. You can't dabble. You can't gamble on a tip your cousin gave you. You'd study. You'd wait. You'd only swing at the pitches you truly understood. And that's the whole point. Scarcity forces quality. When choices are unlimited, we treat each one as disposable. When they're scarce, we treat each one as precious. But does it actually work? Or is it just a nice metaphor? That's where the data gets uncomfortable. In the year 2000, two finance professors, Brad Barber and Terence O'Dean, published a paper with a brutal title. Trading is hazardous to your wealth. They got the records of 66,465 households at a major discount brokerage. Real accounts. Real money. From 1991 to 1996. And here's what they found. The market returned about 17.9% a year over that stretch. The investors who traded the most? They earned just 11.4%. Think about that gap. 6.5 percentage points. Every single year. The harder they worked, the more they traded, the more they fell behind. They weren't unlucky. They were overactive. Why? Two reasons. Costs and emotion. Every trade carries a fee and a tax bite. And every trade is a chance for fear or greed to make the decision for you. So if doing more loses, what does doing less actually look like in practice? Look no further than the man who invented the punch card idea. Warren Buffett doesn't just preach the 20-slot rule. He's lived it. His entire fortune comes from a handful of decisions he refused to rush. In 1964, American Express was drowning in scandal. The famous salad oil scandal had crushed its stock. Everyone was selling. Buffett studied it, decided the business was still sound, and bought. One punch. A massive winner. Then 1988. Coca-Cola. Buffett invested over $1 billion, about $1.02 billion. People thought he'd lost his edge buying a boring soda company. That stake grew to more than $25 billion over the decades. One punch. Held for a lifetime. He didn't make 1,000 clever moves. He made a few great ones and then did the hardest thing in all of investing. Nothing. He just held. And that brings us to the part most people get exactly backwards. If less activity wins, why does almost nobody do it? Because doing nothing feels terrible. Our brains are wired to equate effort with progress. When the market drops, sitting still feels reckless even when it's the smartest move on the board. There's a cost to all that motion. Studies of trading behavior consistently show the same pattern. Barber and O'Dean found the most active accounts tend to trail the patient ones, mostly because of fees, taxes, and badly timed emotional moves. Activity feels productive. The scoreboard says otherwise. The 20-slot rule fixes this with one trick. It makes inaction the default. You're not allowed to act unless it's worth a precious punch. And just like that, discipline stops being a struggle and becomes a rule. Now, a quick word: this is educational content, not financial advice. Always do your own research. Past performance never guarantees the future. So here's the one idea I want you to carry with you. Your portfolio doesn't need more decisions. It needs better ones. Wealth isn't built by the investor who acts the most. It's built by the one who waits for the rare, obvious, can't miss opportunity and then bets with conviction. Price is what you pay. Value is what you get. And patience is the price of getting rich slowly, which is the only way it actually lasts. So let me ask you. If you only had 20 punches left, how many of the stocks in your portfolio would actually make the card? Be honest, tell me in the comments. I read them. And if this changed how you think about activity and patience, hit subscribe. We do this every single day. Tomorrow, we're tackling a question that trips up even smart investors: the difference between a cheap stock and a good one. You won't want to miss it.